We are being taxed more than ever before thanks to frozen income tax thresholds and inflation. However, there are some easy legal measures that you can put in place to pay over less money to the taxman. I've spent my entire career working for some of the leading UK tax practices, and this video is part of a tax playlist explaining how the UK tax system works. This video is not tax advice, but it should give you some ideas of how you can reduce your tax bill. I'm going to go through 5 of the easiest measures that you can use, and some of the later ones I don't hear talked about very often, so make sure you watch until the end. Number 1 is pension contributions. Pensions are one of the simplest ways that anyone can reduce their income tax bill. And how it works is that some of the money that would have gone to the taxman goes into your pension instead. So using a simple example, let's say that you are a basic rate taxpayer earning £2,000 a month and you don't pay anything into your pension. You would earn your £2,000 in the month and your tax would be £400, leaving you with £1,600 of take-home pay. If you decide to contribute 10% into your pension, you would earn your £2,000, you would pay £200 into your pension, and your tax would be calculated on the £1,800 balance. That would be a tax payment of £360, and your take-home pay would be £1,440. But because you also contributed £200 into your pension, the total money that you keep is £1,640. So you get to keep more money for yourself and you pay less money to the taxman. Pensions are also a tax wrapper, which means that when your pension makes an investment, you don't pay tax on the returns that you make on that investment. So for example, lots of pensions will invest in bonds, and bonds pay interest, but so long as it's the pension that's investing in the bond, you won't pay tax on the interest that you earn. If you invested in that bond personally, you would be subject to tax on the interest that you receive on the bond. Number 2 is the lifetime ISA. The lifetime ISA is a tax-efficient savings account because you don't pay tax on the interest that you earn, similar to a regular ISA. But with a LISA, you also receive a 25% bonus from the government on top of the contributions that you make yourself. So this isn't a direct reduction of income tax, but it is free money that you're receiving from the state. And the way that I see it is that you will pay taxes to the state every month, but then by receiving money back from the state through a LISA, you are effectively paying less if you net those two amounts against one another. There is a catch because you can only use the LISA to pay for one of 2 things. The first one is to buy your first home, and the second one is to save for retirement. You can save up to £4,000 a year into a LISA, and the government will top up your contribution by 25%. So they'll give you an additional £1,000 on top of the £4,000. And the other great thing is that you will earn interest on the total contributions, not just on the contribution that you've made. That means that you have the opportunity to earn more interest, and then over time, that interest will also earn interest. That's known as compound interest, and it's the best way to grow your money over time. There are conditions attached to the LISA, and one of the most important ones is that you can't withdraw your money from your LISA until you're 60 unless you're using it to buy your first home. If you do withdraw your money early, you will be subject to a 25% penalty. But that will take away what the government has contributed, and the way the maths works will mean that you also lose some of the money that you contributed as well. And if you are using it to buy your first home, there's a cap on how expensive that property can be, which is $450,000. If the property is worth more than that, you will be subject to the 25% penalty as well. So if you live in a really expensive area, the LISA might not be great for you. It's a really good way overall to get free money from the government, but you really do need to consider your own personal circumstances. Number 3, transferring savings to a cash ISA. A regular cash ISA is a type of savings account that you can use just like the LISA to shelter your interest from tax. Unlike the LISA, you don't get the government top-up, but it's also extremely flexible in terms of when you want to withdraw the money. So if you currently have savings in a regular account, your interest will be subject to tax. So the best thing that you can do is to transfer that money into a cash ISA to shelter your interest from tax. This starts to matter more when you're a higher rate taxpayer, because basic rate taxpayers can earn up to £1,000 in interest before they have to start paying tax anyway. But interest rates are high at the moment. So if you are a basic rate taxpayer and you have £20,000 of savings in a regular savings account, earning 5% interest, you will soon exceed your £1,000 limit. So by transferring the £20,000 into a cash ISA, you will shelter your money from tax. Number 4, the timing of your expenses. This one will help you if you run a small business or if you have a side hustle. The cash basis of accounting is the default for the 2025 tax year and beyond for sole traders. That means that you only need to declare money in your tax return when the cash is exchanged in your business. That's instead of the accruals basis of accounting, which takes into account when the money is earned or when expenses are accrued. So that means that you could choose to pay for more expenses this tax year so that you can deduct more from your income and pay less tax. I'm not saying to go out and buy extra things because that would harm your business and your cash flow. But if you have expenses that you know that you'll need to incur in April or May, then you could decide to pay for those in March, so you get the benefit this tax year. Because of the time value of money, that tax saving could have more benefit to you now. In a similar way, you could decide to collect cash from your customers after the tax year, so at the end of April or in May, so that would also help you to reduce this year's tax bill, but you would have to make sure that that works for you in terms of cash flow. More expenses in this tax year and less income will help you to pay less money to the taxman. Number 5, inheritance tax. Most people's estates don't fall within the charge to inheritance tax because their estate will fall within the exemption. So it's a tax that applies to the wealthiest people, but the government are making more money than ever from inheritance tax, and there are some simple things that you can do to pay less inheritance tax if your estate is going to fall into it. One of the things that you can do is to start gifting away assets during your lifetime. And one of the easiest ways to do that is to gift away money. And as long as your gifts don't change your lifestyle and they have a regular pattern, they won't fall within the charge to inheritance tax. But if you die within 7 years of making the gift, then some inheritance tax will be payable. So if you think that your estate will fall into the charge of IHT, then it's better to start planning for this sooner rather than later. There's a lot of tax planning that you can do to pay less tax, but these are some of the easiest ones to implement. Thank you for watching. Leave me a comment with anything else that you want me to cover in future videos. Please subscribe if you haven't already, and I will see you next week.